Hello again. Today we're going to talk about Chapter 5. This is the first of two videos on Chapter 5. In the second video, we'll go over the homework. But here are the learning objectives in Chapter 5. Number 1, we're going to identify costs as either variable, fixed, or mixed. This step thing is not something we're going to talk about. We're going to use the high-low method to estimate cost behavior. What does that mean? Well, some of these costs that are mixed have both a fixed and a variable component. And what we're going to do is to separate them. We're going to look at this number 5, prepare and interpret a contribution margin income statement. And then we're going to compare this new income statement, this contribution margin income statement, which is what variable costing is, to full absorption costing, which is the income statement the way you've known it prior to this. So they use Starbucks as an illustration in this chapter. That's something I guess most of us can identify with. How much does it cost to make a cup of coffee? What are the fixed costs? What are the variable costs? So we start out with this discussion of what's called the relevant range. And it's kind of an important topic, but it's something that we can really safely assume in the work that we'll be doing. But what does relevant range mean? It's the range of activity over which costs behave the way we expect them to. See, they say the range of activity over which we expect assumptions about cost behavior to hold true, right? But I just say it's the way we expect cost to behave. A normal operating range of activity. You know, just say, for example, you had a factory, and that factory was capable of making 100,000 units of whatever product it is that you make. If you operated your plant 24 hours a day, 7 days a week, you could make 100,000 units of product. So to make that 100,001 unit, you would have to drastically increase your cost because your factory just couldn't produce any more. So when you get to that extra unit, that nth unit, then all your costs behave differently. You're out of the relevant range. What are variable costs? Variable costs are costs that increase or decrease with the level of production. In other words, if you look at this chart, this graph, the more cups of coffee you serve, the greater your variable costs, right? So if it costs you 50 cents to make a cup of coffee, the more cups of coffee you make, the more your variable costs are. But on a per unit basis, each cup of coffee costs you 50 cents in variable costs, regardless of how many cups of coffee you make. Now, the way I like to think of variable costs, the classic examples of variable costs are direct material, direct labor, and some of the overhead costs. Right? Some of the overhead costs are variable, some are fixed, and some are mixed, as we'll see. But, you know, just for ease of discussion, right, and just trying to get things straight in your mind as you're going through this, think of direct materials and direct labor as being variable costs. fixed costs remain the same regardless of the level of activity. So notice in this example, no matter how many cups of coffee I serve, my fixed costs are $5,000, right? That's what this graph is showing you. So think of something like rent, for example, being a fixed cost. I have to pay my rent every month regardless of how many cups of coffee I serve. Notice though, on a per unit basis, the fixed cost per unit decreases as the number of cups of coffee I serve increase. Right, so again, just to take a quick look, the graphs are kind of the opposite of each other, right? Because the variable costs increase with the more you produce. The fixed costs stay the same. But on a per unit basis, it's the opposite. On a per unit basis, the variable cost stays the same. The fixed cost per unit decreases. Now, what about mixed costs? Mixed costs are partially fixed and partially variable. Something like utilities would be an example of a mixed cost. Something like maintenance would be another example of a mixed cost. So what we have to do with the mixed cost is we have to separate the variable from the fixed. Now they give you a few ways to do it. They have this linear assumption, which I'm not going to do. They have the scatter graph we're not going to do. But we are going to do this high-low method, right? Because the arithmetic here in this high-low method is really not very complicated, and you do have a homework problem where you're going to have to do this. So what you do is you look for each month, you list each month, the number of customers served and what the total overhead cost was. And you can see from this illustration, February was the high month. You served 15,000 customers during February, and the total cost was $15,750. The lowest month was May. You only served 5,000 customers, and your cost was $13,250. What we're going to do is to subtract the high from the low, both total cost and activity. So for example, right, just to follow this illustration through, February was the high month, $15,750. The low month was $13,250. The difference, $2,500. In activity, the high month was 15,000 customers served. The low month was 5,000 customers served. 15,000 minus 5,000 is 10,000. 2,500 over 10,000 is 25 cents per unit. That is the variable cost of making a cup of coffee. It's 25 cents. Now what we do is substitute. So we go back to the formula and we say, okay, the total cost was $15,750. The variable cost was 25 cents per customer. So if I multiply 15,000 times 25 cents and then subtract that from 15,750, I get $12,000. $12,000 is the fixed cost. Now to test it, you make the same calculation for the month of May, the low month. So the low month, we served 5,000 customers times 25 cents. Subtract that from 13,250 and you'll get the same 12,000. So 12,000 would be the fixed cost and anything above it is the variable. So if you have a problem where you do have to separate a mixed cost, right? And I don't think we'll see any in this chapter, but we may see one in another chapter. You have to go through this high-low analysis. Right? And then they have some, some complicated other mathematical approaches to doing this, which are complicated. This high-low method, the math is pretty simple. Okay, contribution margin approach. What is contribution margin? Contribution margin is sales price minus variable costs. Now, all variable costs. Right, we're going to look at costs different now. So all costs are going to be categorized as either variable or fixed. Fixed costs, there's fixed overhead, there's variable overhead. Administrative costs, there are fixed administrative costs, there are variable administrative costs, right? So when we read these problems, we have to just say to ourselves, okay, which costs are fixed, which are variable? So what is contribution margin again? It's selling price minus variable cost. So if you look at the example here from Starbucks, total sales, this is in the month of February, and they served 15,000 cups of coffee, right? 37,500 minus variable costs of 15,000, the contribution margin is $22,500. If I subtract the fixed cost of 12,000, net operating income, 10,500. Now we can also express it on a per unit basis. Per unit in this case would be a cup of coffee. So a cup of coffee we charge $2.50. I don't know what Starbucks they go to. I usually pay a lot more than that. But in this example, they're saying that the sales price for a cup of coffee is $2.50 and the variable costs are $1. The contribution margin is $1.50. $1.50 per cup of coffee. Now I can also express that as a percent. In other words, if I take $1.50 and put it over $2.50, that's 60%. So the contribution margin, sometimes we'll see it expressed as a total number like this. Sometimes we'll see it expressed as a per unit number like this. And other times we can see it expressed as a percentage, in this case 60%. And we're going to need this information more so in the next chapter than here, right? But here they're showing you how to calculate it and getting you ready. Right, and here they take you through the calculations of contribution margin. Ratio as a percentage, when we see it as a percentage, we call it the contribution margin ratio. So what does a contribution margin income statement look like? It looks like this. It's sales minus variable cost is contribution margin minus fixed cost, net operating income. All right, now if we compare that to the income statement that we know, that we've learned how to prepare for quite a while, right? Here it's showing you the differences, right? What I'll call it the normal income statement and the new income statement, right? The normal income statement, we follow GAAP. Well, since this one is for internal decision making, we don't have to follow GAAP. On the normal income statement, we look at costs as being either manufacturing versus non-manufacturing. Here, we look at them as being variable versus fixed. The income statement, the normal way, sales minus cost of goods sold is gross profit. Gross profit minus what they call non-manufacturing expenses, right? Those are the general administrative expenses, is net operating income. With the new income statement, the variable costing, sales minus variable cost is contribution margin. Contribution margin minus fixed expenses is net operating income. Okay. Now, you would think that the number you're going to wind up with, net operating income here versus net operating income here, you would think they would be the same, but they're not. So just be aware of that. The difference has to do with the full absorption statement, including both variable and fixed cost in these non-manufacturing expenses. Right, and here they take you through an example of that. We'll see it in the homework. Right, for example, full absorption income statement, you know, the normal one, the one we've been used to making since Accounting 101. Net operating income, 180,000. Why is it here only 140,000? Why is there a $40,000 difference? And here they're telling you that the fixed overhead of $20 a unit is included for absorption costing, but it is not included for variable costing, right? That's the reason. So if you go through the illustration and you walk through the numbers, you'll see that. You'll also see it in the homework problem we're going to do. So that's all I want to talk to you about in this video. The next video, we will go over the homework for this chapter.